Hi, this is Ian Gendler, Director of Research at ValueLine. We here at ValueLine hope you and your family are staying safe and dealing with this difficult time as best as possible. Today, I'm going to cover the coronavirus and its ongoing impact on the economy and stock market. I will also discuss the actions ValueLine is taking to help our subscribers navigate this difficult time. I will then recommend one stock to buy right now, and finally, answer any questions you may have. Please note that this presentation will be available on our website, www.valueline.com, and on our YouTube channel within the next 48 hours. All previous webinars are also posted. Before I jump into the heart of the presentation, for those joining us for the first time, I want to provide a brief overview of who we are at ValueLine. We are a New York headquartered corporation that has been providing investment research for more than 85 years. Our flagship product is the ValueLine Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on more than 1,700 equities that trade on the New York Stock Exchange, NASDAQ, and Toronto Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by ValueLine's research department, which is comprised of more than 70 analysts, economists, data experts, and quantitative specialists. Our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, ValueLine has no investment banking business with any company, including the 1,700 that are included in this service. ValueLine does not execute trades for its subscribers and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. Now let's discuss the coronavirus. This content was prepared by Harvey Katz, ValueLine's chief economist. The tide may be starting to turn on the COVID-19 front, not all at once, to be sure, but slowly and with great effort. For example, hospital and intensive care admissions are down in key hotspots, while deaths, albeit still distressingly high, are advancing at a more deliberate pace. Such trends, if sustained, will be followed in time by a partial reopening of society, especially in less populated areas, where the incidence of infections is lower. However, we are nowhere near such a shift in course on the economic side. There, surveys on industrial output, retail sales, housing starts, and the leading economic indicators deteriorated sharply in March. Worse, such data reflected an economy that was on lockdown for just the last 2 weeks of the month. April reports will show an even more significant falloff in business activity. Meantime, weekly jobless claims already paint a much bleaker picture, with such filings topping 26 million over recent weeks. In all, these trends, falling oil prices, and weak energy demand point to a double-digit contraction in GDP in the second quarter. Meanwhile, first quarter earnings season is in full swing, and here too the picture is dismal, with many companies missing targets, reducing estimates, and withdrawing guidance. Dividend cuts and omissions often follow, and there have been numerous such announcements. Especially poor results and weak market performances are being seen in the energy sector, while certain stocks, such as Amazon and Netflix, are doing well as more Americans stay at home and shop online. The next month or two may be critical as the country seeks to reboot. Much of the outcome on this front will likely be determined by the continued dedication to social distancing, the ready availability of tests, and the discovery of effective treatments. Even despite such concerns, the case for stocks is a rather strong one. That is especially so if efforts to combat this disease meet with success, new fiscal measures are taken by Washington, and additional monetary actions are employed by the Federal Reserve. We also remind investors that recoveries on Wall Street often precede comebacks in the economy by several months. In conclusion, we suggest accumulating quality stocks that are well positioned to handle further market turbulence. I want to personally focus on one sentence of Harvey's view. Even despite such concerns, the case for stocks is a rather strong one. Although I agree with that opinion, I don't think it's going to be smooth sailing for investors. Stocks are now well off their lows, but I would not be surprised to see some material backtracking over the next few months. Thus, I recommend that investors tread carefully and prepare for a bumpy ride. On that note, Value Line is providing a great deal of information and analysis to help our subscribers. We know that most of our users depend on our weekly stock reports, time-tested ranking systems, and other valuable services. However, did you know that Value Line provides a great deal of daily content that can help you avoid the pitfalls and profits during this volatile time in the market? Every business day, senior members of the research department review the most actively traded stocks, company press releases, news stories, trade periodicals, and other sources for data and information that may change our view and investment recommendations for specific stocks. When something noteworthy crosses our desk, we immediately publish a supplementary report that outlines the new information and, importantly, what it means for the stock and shareholders. This content is posted throughout the day on valueline.com. I will now show you how to access it. First, I need to sign in with my username and password. There we go. From the welcome screen, go to the dashboard. And from the quick links, click on supplementary reports. As you can see, the research department has been busy publishing our updates for many stocks that we track. We strongly suggest that subscribers visit this page often. So for instance, just today, by clicking on 3M, you can see the information we provided. It reported this morning. We are also aggressively adjusting our financial strength grades. Individual companies are dealing with sharply reduced demand for their offerings and supply chain problems, among many other issues. Consequently, corporations have been implementing cash-saving initiatives, such as headcount cuts, a slashing of advertising budgets, and reducing or eliminating their dividends. Taking on additional debt has also been popular as a means to build cash in anticipation of difficult times ahead. Due to the rapidly deteriorating balance sheets, Value Line has been aggressively reviewing and altering our proprietary financial strength grades for the stocks in our coverage universe. These changes are posted each week in our Selection and Opinion newsletter, and since there were so many changes recently, we emailed out the list to our subscribers. Now I'm going to head back to the dashboard and just show you where we posted information in the Selection and Opinion. This is our weekly Selection and Opinion newsletter. Starts with an economic commentary, updates on our 4 20-stock actively managed model portfolios, other important information for investors and subscribers, and on the second to last page, you'll see a table, changes in financial strength. These changes are also reflected on our digital stock reports on the next Monday. For those of you that don't know, financial strength, along with price stability, another proprietary Value Line measure, are the 2 metrics that are used to calculate a stock's safety rank, a key measure of risk. When considering a new stock to invest in, we strongly suggest you utilize financial strength and safety in your decision-making process. This especially goes for the time we're in now. For more information in regard to our proprietary ranks and ratings, Value Line provides a user guide that can be accessed via the investment education section of our website. Now let's move on to the one stock to buy right now. For this, I worked with a number of my senior analysts, and we ran a series of screens and focused on many specific investment and company attributes. This is a good time to mention that subscribers have access to a number of useful tools, including alerts, watch lists, and a screener. The screener includes 50 customized fields and preset screens, so you can surface only the stocks that meet your unique criteria. Anyway, we evaluated stocks that were ranked favorably for safety and should perform relatively well in the future. That is, if times remain tough, or if we enter into a sustainable economic recovery period. We also carefully evaluated management teams, balance sheets, and other attributes. After much deliberation and back and forth, we wanted to provide a conservative choice, since we do worry about the market over the short term. All told, Air Products and Chemicals, ticker APD, is today's one stock to buy right now. I'm now going to provide some specific information and our analysis on Air Products. Let's go to our digital report. Right off the bat, you may notice that APD is top ranked for safety and timeliness and garners our highest grade for financial strength, A++. In the banner section, you'll notice that our 3 to 5 year target price range is $265 to $325. Its current price is around $223, so there is certainly upside potential here. Granted, many other stocks in our coverage universe offer far greater appreciation, but most of those come with greater risk. Again, we wanted to offer a more risk-averse stock that can help form the bedrock of one's portfolio. Let's now scroll down to the valuation module. A quick scan shows that sales, cash flow, earnings, dividends, and other metrics are all trending in the right direction. In fact, Value Line estimates increases in 2020 and 2021 in the face of the coronavirus. Please note that our estimates are in bold. I'm now going to display our classic one-page report to get more information as to why Air Products may well perform so well. These reports can be accessed from the button at the top right. Associate Research Director Mario Ferro stated the following in his new report. Air Products stock has fared relatively well during the recent market collapse. The shares have lost less than 10% of their market value since our last report in late January, while many other stocks have tanked in the wake of the coronavirus pandemic. One of the reasons behind the strong relative performance is that the company provides products, services, and equipment that is considered essential, including medical oxygen, gases for food freezing, and related equipment for energy and medical needs. Indeed, Air Products has been delivering medical liquid oxygen and helium to hospitals and assisting in a number of COVID-19 recovery efforts. Looking ahead, the company will likely show solid earnings growth in fiscal 2020, year-end September 30th. Although we have scaled back our profit estimate by 45 cents to $9 a share, this would still represent a nearly 10% year-over-year gain. Most of this will be driven by the continued ramp-up of previously inked contracts and startups. For 2021, we are looking for earnings to advance 10% to 15%. As for the stock, it is ranked to be a top relative performer over the next 6 to 12 months. In addition, unlike so many companies who have already announced dividend cuts or eliminations, we think that Air Products will be able to easily fund payout increases. All told, this high-quality issue should interest a great many investors, and it is today's one stock to buy right now. I will now tackle your questions. Please note that I typically can't answer complex questions about specific stocks on the spot. For this, I recommend a review of our latest reports. The first few questions were submitted prior to this presentation. Besides buying stocks in the tech sector, like Microsoft, what stocks in tech pay the best dividends? Well, it sounds like a good excuse to go to use our screener, which can be accessed within the Find Ideas tab. All right, so we're going to start with the industry portion. Tech is a sector, and we sort by industries, but you can search for more than one industry at the same time. So by doing that, industry is one of. And then for tech, we can do computer software, IT services, internet, and I'll put e-commerce in there. There's certainly several others, but this gives us a universe of 485 stocks, which is plenty. And of course, the question was, stocks pay the best dividends. So we can add dividend yield to our search. Let's say we want to set the minimum range to 3%. That gives us 11 candidates. And of course, you can sort the list from low to high, or I guess in this case, we'll sort it from high to low. Remember, screens are the start of a search, not an end. So if this is something that would interest you, I would recommend looking at the top individual reports. And that can be done by simply clicking on the company name. All right, next question. Can you walk us through the key pieces of data provided in the Value Line report that indicate a strong balance sheet? Okay, I'm going to use the Air Products report as an example. A great deal of balance sheet information is included in the capital structure and current position boxes. Things that I like to look for is the percentage of capital. That's long-term debt to total capital. Total capital is defined as the sum of long-term debt and shareholders' equity. You would typically want a relatively low percentage, perhaps below 50%. Air Products has not a great number of debt, so it's a good indicator. You can also note that just cash assets alone is similar to long-term debt. So if they really wanted to, they probably could pay it off. But in this day and age, their debt is usually being paid at a low interest rate. So carrying debt is not problematic for good quality, large companies that are profitable. As you can see, their long-term interest is only $135 million a year. And we think they're going to make upwards of $2 billion in profit this year. So debt is not an issue for Air Products. And also take a look at current assets versus current liabilities. As you can see, current assets are about 2.5 times current liabilities. So again, they don't have anything on their balance sheet that appears problematic. You can also see the trend in long-term debt going back a decade. As you can see, overall, they've been paying it down slowly. But we do think it's going to ramp back up over the next 3 to 5 years. Debt is inexpensive now. It can be advantageous for a company to take on more debt to fund operations that they think they can get a bigger return on. So those are the kind of the quick key things to look at for balance sheet items on our reports. Next question. Do you think the worst of the COVID impact has hit the market, or are there new lows to come as companies report their earnings for this quarter? As I mentioned in the report, I don't think necessarily we're going to retest the lows of last month, but I certainly don't think the recovery is here to stay. I think it's going to be a bumpy ride. I could definitely see the market losing significant value over the weeks and months ahead. Remember, companies are reporting March quarter numbers now. And as I mentioned in the report, that was only a couple weeks worth of quarantine. The current quarter is going to have far more of an impact on results. So we'll see when those get reported. But remember, that won't be till July and August that we'll hear from those companies. What changes do you see in the world after the virus, and what will be the financial effect? I think eventually, life will return to normal, but but not for all industries. I could see the airlines having trouble for quite a long time, especially when it comes to business travel. I think you're going to see corporations permanently reduce, maybe not eliminate, but permanently reduce business travel. I think you're going to see fewer flights, maybe fewer airlines. It could be another wave of consolidation like we saw after the last recession. Movie theaters may not return to previous levels. I also think that could be a function of new streaming platforms. Just as an example, and this is off the top of my head, I'm not saying it's going to happen, but I could see some of the new big superhero Marvel releases being put on Disney Plus rather than in movie theaters, maybe for an additional charge. But I don't think movie theaters are going to succeed even after this pandemic ends. And of course, retail. More and more people are now buying items online. I think that trend is here to stay. And I think you're going to see, I don't think you're going to see very crowded malls for a long time. I think you're going to see a lot of vacant stores. Next question. What's your recommendation for using the technical rank? So again, we can use Air Products as the example. As you can see, the technical rank information is right there. This, just like timeliness and safety, is ranked on a 1 to 5 scale, with 1 being the best. 1s and 2s are expected to outperform the market over the next 3 to 6 months. The information that goes into technical, it is a proprietary calculation, but it uses just recent stock price action to calculate the ranks. We do recommend that you use it as a secondary consideration, but it is an important thing to keep track of. All right, let me find some more questions. Bear with me. Here's a question about the next mail date for the Value Line 600. That will be mailed out in 2 weeks, so you should see it in about 3 weeks. All right, there's several questions about what I think about the stock market, the recent rally. Just to reiterate one more time, I do think a recovery in the market, I think, is a little premature. I do think that it's going to be a bumpy ride. I will say it appears that the Fed and the government are going to do everything they can to prop up the economy and stock market. It's especially true before November's election. How do you determine if a company has a higher debt load versus their competitors? We can do that in the screen too. So let's say you wanted to compare all the big aerospace and defense companies. And then there's a couple ways to do it. From the balance sheet items, long-term debt, and then you can sort by debt. For instance, the company with the largest amount of debt is, not surprisingly, Boeing. You can also do it if you want to look at it in relative terms. You can do long-term debt to total capital. That was the percentage I was looking at Air Products earlier. This is a pretty good measure because it'll take the company's relative size into account. But note that share buybacks massively influence these percentages. As companies buy back stock, which granted they're not doing in force right now, but we're aggressively doing in 2018 and 2019, buybacks lower shareholders' equity, which would then increase this percentage. So using the screener, you can look at these forces and factors versus each other, but an individual analysis of each company would be required thereafter. Another question, if I have a print version, can I see the research discussed today online? In most cases, a print subscription does not provide you with access digitally, but you can easily add digital access to your subscription. And if you'd like to do that, you should call 1-800-VALUE-LINE. Do you provide recommendations or only quantitative analysis? No, we provide both. Everything that I've done here today is my own recommendations and the recommendations of the research department. That's where the analyst commentary, the supplements come into play. Quantitatively, of course, we do have the ranks, but we also give you a human opinion. As I mentioned, the research department has approximately 70 analysts. Yes, the webinar will be posted on our website and YouTube within the next 48 hours. Here's a question about the stocks we cover and on what exchanges. We cover stocks on the New York Stock Exchange, NASDAQ, and Toronto Exchange. With that, approximately 200 of the 1,700 stocks are foreign, and we cover the ADRs that trade on U.S. exchanges. Question about the financial strength rating. Is it quantitative, qualitative metric, or both? It's both. There is a computer-aided formula, but we also have human oversight, especially now with companies reporting drastic changes to their balance sheets and financial estimates. Here's a question about investing in one of our model portfolios. We can actually go back to the selection and opinion, and we'll take a look. While I'm getting there, note that each portfolio has 20 holdings. They're actively managed. Updates are provided once a week. And each portfolio always has 20 stocks. We recommend that if you want to duplicate one of these portfolios, that you take an equal dollar value estimate into each holding. And then, of course, trade information, any kind of changes to the portfolio, we provide weekly in these written commentaries. See if there's more questions. Here's a question: do you base your analysis on company-based? Do you base your analysis on company-provided information, or do you make adjustments? So we tend to make adjustments. We alter our financial presentations to account for non-recurring gains and losses, one-time items, discontinued operations, things like that. Those changes are reflected in the footnote section of our reports. So as you can see right here, we've excluded non-recurring gains and losses, as you can see, pretty consistently for Air Products. What is the Value Line's stance on share buybacks? All right, so that's obviously been a hot button issue, as companies that are now struggling financially have spent billions repurchasing their shares. Boeing is a good example. Personally, I am not fond of buybacks. For the most part, I think there are better uses of capital for corporations. That includes simply giving it to your shareholders in the form of dividends. But I think we learned recently how tenuous some of these companies' financial positions were. You know, just a few weeks of disruption sent them to the government asking for or begging for loans or assistance or bailouts. That's another thing you might see going forward is fewer buybacks and companies hoarding their cash more significantly. I hope that to be the case. Here's a question about companies with theme parks. I didn't mention that when I was talking about industries that may continue to suffer. Yeah, I mean, any company that depends on large gatherings, so companies that own sports teams or venues, maybe companies like companies like Ticketmaster, are all going to feel the effects long term, in my opinion. Here's some questions about Air Products PE. As you can see, it's currently trading at 23.8. That is a higher than market PE. But if you look at their historical PE the last several years, and this is relative to the overall market, Air Products for the past half decade has traded at a premium to the market. So I'm personally not concerned. I think their quality of business merits a higher PE. All right, I got time for one more question. If you have more questions, feel free to email me at igendler@valueline.com. That's igendler@valueline.com. All right, let me just scroll down and take one more question. What are the key indicators to look at and judge to whether a company is doomed? I mean, definitely look at safety, financial strength. I also, I think the best thing to look at is recent stock price action. If a stock price is in free fall, that could suggest that, financial peril is near or bankruptcy concerns may emerge. Also, I would recommend looking at our analyst commentary and supplements. We will, of course, report on things of that nature. Okay. Thank you so much for attending the webinar. The questions were great. Stay safe and take care.